Ever applied for a loan or a credit card only to be met with a confusing rejection? You check your bank account, everything seems fine. So what gives? Well, there might be a hidden culprit lurking in the shadows of your financial life, your credit score. But wait, isn't there just one credit score? Not quite. In the UK, there are actually three main credit reference agencies, CRAs: Equifax, Experian, and TransUnion. Each one collects information about your borrowing habits and creates a credit report for you. And guess what? These reports can vary slightly between each agency. That's why you might have a sparkling score with Experian but get red flags from Equifax. So, are Equifax and Experian the same? Not exactly, but they're definitely in the same game. Let's dive deeper and understand the world of CRAs in the UK. The Credit Report Crew, unveiling Equifax and Experian. Imagine Equifax and Experian as detectives. They gather clues about your financial behavior, your payment history, credit card utilization, even public records like electoral roll registrations. These clues are then compiled into a detailed report, your credit report. Here's the catch: lenders don't necessarily report to all three CRAs. So, the information Equifax has on you might be slightly different from what Experian holds. This can lead to discrepancies in your credit scores, even though they're based on a similar story, your financial responsibility. Why the discrepancies? Buckle up for credit score shenanigans. There are a couple of reasons why your credit scores might sing different tunes across Equifax and Experian. Selective reporting. Remember the detective analogy? Lenders have the liberty to choose which CRAs they report to. Bank A might use Equifax, while Bank B relies on Experian. This means each CRA might have a slightly incomplete picture of your credit history. Scoring nuances. Both Equifax and Experian use complex algorithms to calculate your credit score. While they consider similar factors, payment history being a big one, the exact weighting and formulas can differ. So, even with the same information, you might end up with slightly different scores. Why does this matter? The real-world impact. So, these discrepancies might seem like a technical quibble, but they can have real consequences. When you apply for a loan or credit card, lenders use your credit score to assess your risk, how likely you are to repay the borrowed money. A lower score with a specific CRA could translate to a higher interest rate or even a rejection. Taking control. Be your own credit score detective. The good news is you're not powerless in this game. Here's what you can do. Check your credit reports with all three CRAs regularly. By law, you're entitled to one free report per year from each agency. This way, you can spot any errors or inconsistencies and get them rectified. Maintain a healthy credit history. This means paying your bills on time, keeping your credit utilization rate low, not maxing out your credit cards, and diversifying your credit mix, a combination of credit cards and loans. Understand the score variations. Don't panic if your scores differ slightly between Equifax and Experian. But if there's a significant discrepancy, investigate the cause. There might be errors in one of the reports. The takeaway: don't be a credit score victim. Equifax and Experian might not be exactly the same, but they both play a crucial role in shaping your creditworthiness. By understanding the system and taking control of your credit report, you can ensure these detectives are telling the best possible story about your financial responsibility. Remember, a healthy credit score can unlock better loan terms, lower interest rates, and even cheaper insurance premiums. So, take charge, be proactive, and don't let these credit score shenanigans hold you back. With that said, thanks for watching, and until next time.